How can students measure investment risk? Imagine trying to hit a target while blindfolded. That's what investing can feel like if you don't understand how to measure risk. Knowing how much your investments might go up and down helps you make smarter choices. So, how do students figure out how risky an investment really is? Let's explore some simple tools and ideas. First, understanding what investment risk really means is key. It's the chance that your actual returns will be different from what you expect. Sometimes you might lose money, or your gains might be smaller than planned. Recognizing this uncertainty is the first step for students. Next, think about volatility. This is how much an investment's returns bounce around over time. If the returns change a lot from month to month, that investment is more volatile and riskier. To measure this, investors use something called standard deviation. It shows how far the returns typically are from the average. A higher number means more unpredictability and risk. Another important idea is beta. Beta compares how much an investment moves compared to the overall market. If the beta is more than 1, the investment tends to move more than the market. If it's less than 1, it moves less. For example, a beta of 1.2 means the investment usually moves 20% more than the market does. This helps students see how sensitive their investment is to market changes. Students can also look at something called value at risk. This tells you the most you could lose over a certain period with a specific confidence level. For example, a one-day value at risk at 95% confidence might say there's a 5% chance you could lose more than a certain amount in one day. It's a way to estimate potential losses under normal market conditions, but it doesn't predict extreme events. The Sharpe ratio is another helpful tool. It compares the return of an investment to its risk. A higher Sharpe ratio means you are getting more return for each unit of risk. This helps students see if the extra reward is worth the risk they are taking. Diversification is a simple way to reduce risk. By spreading your money across different assets, sectors, or regions, you lower the chance that all your investments will lose value at the same time. Even with limited funds, students can choose different stocks, bonds, or funds to help protect their money. Scenario analysis and stress testing are also useful. Imagine different situations like a recession or a market crash. Thinking about how your investments would perform in these cases helps you prepare for possible losses and plan how to protect your money. Finally, calculating expected return helps students understand the balance between risk and reward. If you consider the chances of different returns happening, you can estimate an average expected return. Comparing this with the possible range of outcomes shows how much risk you're taking to get your potential gains. In summary, students can measure investment risk by looking at volatility with standard deviation, market sensitivity with beta, potential losses with value at risk, and risk-adjusted returns with the Sharpe ratio. Practicing diversification and scenario analysis also helps. These tools give a clear picture of how much risk you're accepting and help you make smarter investment choices suited to your goals.